Hi, everyone. This is the first episode of Two Gray Beards. Nick and I look forward to talking with you every week, and we'll make this short and sweet. To start, we want to place the discussion in the large themes that we believe are playing through markets right now. And the first one is that the Fed and global central banks will do enough to bring inflation under control. We'll see how long it takes. They've done a lot, but it's very important to know that no one knows if they've done enough or too much. But what is pretty likely is they haven't been just right, particularly as just right implies globally coordinated just right, and each region of the world is at a different place in the cycle. So, if we knew that the Fed had overdone it by the hikes that they've done, the asset allocation would be easy. We'd be overweight bonds and underweight stocks. If, however, they haven't done enough, we'd be the opposite. So, see how important it is to know, and we don't know. The power of not knowing when cash offers 4.5% returns is fantastic. It's the opportunity to sit on your hands with a large cash allocation, and at the margin, when markets provide opportunity and one scenario or another appears to be playing out, may not actually be playing out, but appears to be playing out, you can position yourself strategically. Lastly, one big theme seems to have major legs, besides the general idea of central banks and asset prices, etc. The one big theme is something that I've called the three Ds: deglobalization or onshoring, domestic energy infrastructure investment, duplicate supply chains. All of these ideas are post COVID, post supply shock problems, and are related to the global geopolitics that is ongoing. All of them need investment dollars to come from the private sector, which will keep asset prices under pressure, and are short term inflationary and pro growth, making the Fed's job harder. What you'll notice when we talk through our asset allocation, within equities, it's tilted toward this theme, and it's part of why we don't know if the Fed has done enough or too much.
And Happy New Year to everyone. To start off with, the reason why Andy and I are doing this together is because we very much view the markets in the same way, which is not really surprising given that we are old Salomon Brothers alumni. We've learned to look at the world very much in the same way, and certainly the investment world. I very much agree with him about the themes of deglobalization, and you will see in a moment, according to our equity allocations, how we plan to take advantage of those. But also, I very much agree that we just don't know whether the Fed has done enough as yet. And even if the Fed has done enough, it might very well be true that other central banks haven't done enough. For example, the ECB or the Bank of Japan. And what that does is exacerbates the QT that's happening in the US. If you have the ECB, which is going to start QT sometime, very probably in Q1 of 2023. That puts pressure on German bonds and Italian bonds and French bonds, narrows the spread between the US and those bonds, and unfortunately, because of the QT that's happening in the US at the same time, makes those bonds just bleed, let's say, even though they might have reached appropriate levels to control inflation. There is no guarantee that those bonds won't tighten more, and therefore that eventually push the whole economy into recession, the world economy, let's say. It's very difficult to tell at the moment. I think we'll be able to tell sometime in Q1, but at the moment it's very difficult to tell, and our allocations have to be defensive and mostly in cash because of that reason.
Yeah, so with that great uncertainty and that not knowing and the great opportunity for cash, our Nick, what do you think the right allocation is? Remember, we're talking to long only investors who don't go short. And so, what do you think the right allocation is for cash relative to any asset?
I think it's around 50%. The
That's pretty defensive.
It's very defensive. On the other hand, if you look at all the charts, you are seeing that equities and bonds are very much locked together in terms of performance, which has been the story really of 2023. Whether you'd bought S&Ps or bonds, it's much of a muchness. You've lost nearly as much in either. And therefore, until, as we just said, we know how the economy is going to respond, whether it's going to go into recession or not, I would have thought being defensive and having a very high asset allocation to cash is the right move for investors.
I think 50% makes plenty of sense. In a market like last year, where 60/40 portfolios ended the year down about 20%, that allocation would have saved investors 10%, a significant amount, plus any interest that they would have earned on the cash, which initially was low. So I think it's a good buffer. So I think the first theme is right now, with uncertainty in place, cash is king. And, we'll see which asset becomes king. But for now, cash is king.
Cash is definitely not trash at the moment.
So let's drop down to how we handle cash. A lot of investors say holding cash is a problem in an inflationary environment because you lose purchasing power. And while inflation is coming down, it's still 4-ish% on a year-over-year basis, sort of for 2023. Inflation expectations are lower, but holding cash can be expensive. One of the ways I like to manage cash is hold both T-bills, which pay a fixed nominal rate, and holding very short-term tips, which are interest rate sensitive instruments that pay you the actual inflation. And so by diversifying between those two bits, I like to have a little bit of inflation in case I'm wrong and inflation stays high, and a little bit of nominal in case I'm also wrong and inflation craters. So I was thinking an allocation of short-term tips, which are easily bought in the STIP ETF, and then sweep money into a money market fund or some form of mutual fund.
Something like a Vanguard Federal Money Market Fund, paying you over 4% at the moment makes perfect sense.
Right. So, maybe a 50/50 allocation for that cash allocation seems to make sense to me. What do you think of bonds? We had this major, for sophisticated investors, we had a major shift after the CPI where the bond market rallied massively from the lows. The TLT, which is a popular ETF, went from the low 90s to 109, I think, 110 maybe even. And that was very much on a very, a change in inflation expectations, but also a real unwind of some levered positions that were short the bond market and which had been winning for the whole year. Now that's shifted back, and we're sort of in a no man's land right now with long-term bonds. What do you think about an allocation in bonds? We've got 50% cash to deploy. What do you think?
I think we wait. I mean, we deploy some, but we wait. The level I don't think is right. I like the 95 level in TLT. It all
And we're
depends on
99 now.
it. Yeah, 99 and a half. It all really depends where the what the NFP number is going to be, and we can't tell. We'll be able to reallocate much better or much more in a much more informed way next week.
Yeah, I agree. I think, with the Fed minutes, which may not be anything on Thursday, and the non-farm payroll on Friday, a small allocation of bonds, sort of a balanced allocation, but again, we're 50% cash, which we can deploy, and sort of look to buy in the event we have a meaningful sell-off. Seems to make sense to me.
Absolutely, something around 15 to 20% in bonds, whether it be TLT or tips. A balance between the two looks about right to me. I think
Yeah.
equities is actually the hardest one to allocate, simply because there are so many themes going on. One is the fact that whether you buy TLT or you buy SPY, you seem to be buying the same thing, and give or take a few percentage points up or down. But the main themes that have worked for me in 2022 personally have been defense, and so that's a ETF called ITA, which has performed massively and actually
Defense contractors.
yeah, and it's actually performed so well that it's ended the year up, which is one of the very few equity ETFs that has. I would hate to not own it at the moment because it has the wind at its back, what with the war in Ukraine still, and the fact that the European Union is going to have to rearm and they're going to have to buy NATO standard weapons, which the US produces. And it's just
Yeah, I
about
like
the only
that theme
country
too.
that does.
Nick, on the overall equity allocation, you know, I'm cautious, and that's again, we've talked about being in cash. Most of our allocation is in cash, 50%. But owning a little equities in case the economy stays stronger than we expect seems sensible. I did look at the valuations though recently, and you know, earnings growth expectations for 2023, even though there's some fair chance we're heading for a deep recession, are still 5% higher than this year, which was a significant growth from last year. And 2024 earnings expectations are another 10% higher from that.
Yes.
Those two things don't add up for me. And so, I agree that while we probably should have some equities, we're long only. We're not taking short positions. Um, it seems to me that the equity market's quite vulnerable, and you'd want to be defensive, not in defense contractors. I mean, just overall defensive. And so, again, some balance in case the economy does stay strong for long. Um, but pretty defensive, and in sectors away from the US and in certain sectors that do better at the margin makes sense to me.
Yeah, I mean the sectors that I like, rather the countries that I like, are the ones that are associated with the deglobalization and onshoring of supply chains that you mentioned. Countries like Mexico and Latin America in general, which are very firmly in the US orbit of influence, but also Indonesia, which I think is a major commodity producer, and where the population growth is very strong and the reform process politically is very strong. I think that has a chance to outperform the US. So small allocations to those themes I think are warranted. And you will see that in the chart pack and in the Excel sheet that we provide with the
Great.
exact allocations that we want to give.
What about gold and commodities? I think gold is a great balance in case any fiat currency crisis of any sort, or the overall fiat crisis, which is not something I anticipate, but something where you never know. It's good asset to hold. What do you feel about gold?
Gold, I feel, has performed much better than bonds and slightly better than equities this year. And I, the way I've been trading it is to buy it every time it hits 1764. That seems to be a great level. It's there. So really, if you want to add to gold, it's 1764. But you have to own some. You have to own approximately 5 to 10% of your portfolio in gold, and much the same kind of thing in commodities.
Sorry, could you imagine us scaling in or out over time, but keep around a core long?
Yes, I would scale. I would hold a core long of about 5% and add another 5% every time it dips to 1764. That's the kind of thing that I'm looking for.
Sure. How about commodities? I think commodities have been under the gun lately. Oil's down a lot. Um, and other commodities, particularly housing related commodities, have fallen quite a bit, which all is sort of, a canary in the coal mine for a recession.
Yeah.
But, again, if the Fed hasn't done enough and labor stays strong, there's going to be demand for finished goods. And, commodities are an important part, particularly the energy sector, in keeping these factories running. Plus, you have the China reopening, which could be a source of demand for commodities. What do you think?
Certainly, I prefer gold to commodities, but only slightly at the moment. I'll include in the chart pack a chart which shows you that the ratio of gold to commodities is starting to improve from a level where it traditionally, on a very long-term chart, it tends to improve. And therefore, I would prefer a slightly larger allocation to gold than to commodities, and I think that is very reasonable.
I think broadly we're in agreement this particular episode. It's going to be interesting over time as we will invariably disagree, and we'll have to work it out in front of you all. But broadly, we're in agreement. How does the portfolio look? Did you put a spreadsheet together that we can look at?
Yes, I've put in a spreadsheet together, and I can actually share it with you now if you like.
Great.
Okay, so I've started with a original allocation of $250,000, and this is how I've split it. In equities, 25%, in bonds, 15%, gold and commodities at the moment, 10%, and cash likes 50%. So mostly the equities are in S&Ps. These are the shares that we will be buying on first thing on Tuesday in each sector. No need to bore you because this Excel sheet is included in your pack, and you can download it and study it at leisure. We've included SPY, ETA, which is the defense ETF, a little bit of Mexico, a little bit of Latin America, a little bit of Indonesia, a little bit of XLY, simply because it has been so trashed, and I'm beginning to like the Amazon level, and a little bit of Dow Jones because that's more defensive than SPY. In bonds, as you can see, 50-50 allocation between TLT and TIP. And in commodities, slightly more GLD than DJP. GSG is a very good alternative to DJP, which I actually prefer. but I can't buy it at the moment because of a tax problem, but I'll have that sorted out next week. So if you prefer GSG, and you should, please go ahead and buy that instead. It would be 471 shares at the close. And cash, I'm going to put $75,000 in the Vanguard money market and $50,000 into STIP. That allocation, speaks for itself. Very defensive. I've included in the next tab a chart pack. You can click on these links and you can see the charts for each one, and the reasons why we are very defensive should become obvious to you.
Well, Nick, I think that's a complete set of things for our listeners and viewers to go through. Coming back, the themes are what's important for us, and in our view, the best thing for you to do is to take this information and use it to challenge your financial advisor. We're not your financial advisor. This is what we're doing with our money. Nick will put it into a institutional broker's account on Tuesday, and we will track it. But this is what we're doing, and it's something that you can use the themes that we've discussed and the positions we've done and our allocations to challenge your broker.
Very much agree. This is not to be copied exactly, or you can if you like, but this is to give you ideas and to see how things change over time, and when we add risk and why, and when we reduce risk and why we do that.
Thanks for listening. Thanks for watching. Have a happy new year.
Happy New Year. Thanks for watching, and hope you'll be with us for the rest of 2023.